The S&P 500 is still higher this year, but it's lost more than 7% since the end of July. Our next guest has been one of the stalwart bulls on the street. Has the recent selling made him change his tune at all? I suspect not. Joining us now is John Stolfus, Oppenheimer Chief Investment Strategist. John, it is fantastic to see you as always. It's my understanding you still have that 4,900 target for the S&P 500, which is looking further away from here. What gets us there here? What are the silver linings that folks are missing, maybe?
Well, first of all, great to be on the show with you, Julie. The first thing is when we put the 49 target in, we put that in at the end of July as our 4,400 target that we'd put in for the S&P 500 last December had been exceeded. We'd closed over 4,400, and so we had to do something with it. And we thought if we left it at 4,400 at that time, it would have seemed bearish to some. If we'd only raised it to 4,600, it wouldn't have been much of a jump from that level, because at the end of July, I just checked, the S&P 500 was at 4588. So the 4,900 target at that point looked like about 6.8% upside from that. So we were allowing for some kind of pullback in the fall. Be careful what you wish for, right? But when we look at it, we'd say the 4,900 looks like it's still very possible. And what we have to take into account is what's caused the market, in our view, to go through this tizzy that it's going through. Combination of seasonality. There were various options expiries that also occurred. Still a lot of people, who are in their 30s today, who are only 15 at the 2008 financial crisis. So all they've known is low interest rates. My first mortgage was 10%. If I could have gotten a 7 or 8, I would have just been thrilled, believe me. And my boss's first mortgage was 16%. And I recently ran into somebody who had an 18% and a 20% mortgage. We all survived. And so did the real estate market. But when it comes to where we are today, we've got to think that the numbers tomorrow could help some. If that jobs number comes in hot, the market's got to get rattled. If it cools off too much, the market will say, oh my gosh, we're going into a recession. If we get a Goldilocks number, we'll probably gain to close the week higher. But we are expecting that here in October, we'll get some kind of calming when the market realizes that the end of free money is a good thing. We've had years where bond issuers have not paid for the privilege of borrowing money because interest rates were set to emergency standards by the Fed, whether it was the financial crisis or the pandemic. And with the pandemic, we had turbo fiscal policy stimulus. And now we got to go back to a more normal time. And how nice for bond buyers to actually get coupons that are fairly decent, especially when you've got so many baby boomers moving towards retirement.